Welcome back to Actual Investing. Today I thought I'd make a video talking about 3 stocks that I think are still cheap. Right now we're in a bull market that kind of came out of nowhere, just a sudden bull market, and that's been leading a lot of investors to believe that the market is slightly expensive, given that lots of stocks have run up quite significantly in the past month or two. So I thought I'd make this video to kind of go over 3 stocks that I think could still be good buying opportunities when everything else is quote-unquote expensive. So the first one, without any further ado, is Pfizer. So Pfizer stock is actually at the lowest point it's been in 5 years. So here's a 5-year chart of Pfizer. It is down 29.7% in the past 5 years. Now, a quick word of caution is that you shouldn't look at a stock's price movement to determine whether it's cheap or not. So let's say a stock is down 80% year to date. You might say, oh man, that stock is so cheap. Well, yeah, it could be cheap, or it could be going bankrupt, or it could have some serious concerns. Don't just look at the chart and say, oh wow, the price is down, time to buy. Buying the dip is usually a nice idea, but you shouldn't just look at the chart and say the stock is cheap. So I'm gonna head over to Investopedia, who has a really nice little blurb about why the shares are down. So Pfizer's revenue guidance and profit guidance actually came up short of Wall Street's expectations, but came in higher than Pfizer's own guidance. So I think Wall Street's guidance was Wall Street's expectations, I should say, were a little bit too optimistic. I think people thought that the virus revenues were going to be more significant than they are. And I think that's also why Pfizer had such a great year during the virus time, is because they were making so much money. All that money that they have made has allowed them to acquire Seagen, which Seagen is going to hopefully help them to accelerate their growth, as Seagen had really nice revenue growth. And also, Pfizer has their own pipeline of drugs that could have some good potential. So with pharmaceutical companies, you really have to speculate a little bit and hope that that they're going to have continued success with their drug discovery. And I think Pfizer has a good shot at that. They're doing some exciting things too with a smaller company called Beam Therapeutics. They have a little partnership with Beam in the gene editing space. Here on Morningstar, they say, I'm going to butcher this name, but their cardiovascular drug, Vynaquel, I think it's Vynaquel, could be a game changer in the rare disease arena. I tend to agree with that. I think that's going to be the next hot thing, is that everyone's going to be going after these rare diseases that are untreated. So anyway, so this is Morningstar. This is just a stock research website that I pay for, and this is Pfizer. Morningstar claims that Pfizer is a 5-star stock, so they think that the stock is undervalued right now. Their fair value is 42, take that with a grain of salt. But I just kind of wanted to point out that even though they have not quite met Wall Street's expectations, you can't deny that they're cheap, because if you look at PE ratio, which is typically used as kind of a one-stop shop to value stocks, it's sitting at less than 16. And the nice thing is too that they have not cut their dividend. Their dividend is still paying out about 6%. So if you're a dividend investor and you don't mind maybe having to wait a little bit for the recovery, or you have a long time frame, I think Pfizer is a great stock to buy right now. So let's move on to the next one, which is not a value stock, but a sort of blend stock, and that's PayPal. So PayPal, I think, is very popular among these YouTube finance types, but I'm still going to talk about it anyway because it's a stock that I think the market has been way too rough on. So we can see that year to date, it's down 16%, but if we zoom out, it's really down from its highs, which maybe it never should have been at $300 a share. I think that's quite extreme. But you can kind of see that in the past 5 years, just like Pfizer, PayPal is down. So why is PayPal down over such a long period of time? Well, I think there are concerns with PayPal's moat. I think that the market thinks that maybe PayPal isn't quite as innovative as it seemed, and that maybe it's losing some of its competitive advantage, right? Because there's a lot of competitors. I think Square/Block is the big one. Block has the Cash App, which is, a good competitor to Venmo. And then they also are kind of in the business space as well. So business payments as well as peer-to-peer consumer payments. So Morningstar says PayPal is a 5-star stock as well. They believe it's worth $135. And I like this guy, Brett, says the market is overly pessimistic about PayPal. Brett, I agree with you. I think the market is very pessimistic about PayPal. I think even though PayPal may be losing some of its moat, and there are some good competitors out there, including Block, you can't deny that they are still growing revenues. And I think their new approach now, which is to, instead of capture new customers, to expand their current customers, that's the new approach that they're going towards. I think that's going to pay off for them really well, because I don't know anyone who doesn't use PayPal. I mean, my parents use PayPal. That's saying something. So I think that PayPal already has a great customer base, and now they need to squeeze a little bit more money out of those customers, and that's what they're planning to do. And I think and hope that that's going to pay off for them. So the final stock now is Chewy. And if you're not from the US, you might not have heard of Chewy, but if you are from the US, you definitely probably have heard of them. They are huge. They advertise all over the place. If you walk around your neighborhood, I'm sure you're going to see one of those big old Chewy dog food boxes on somebody's doorstep. They're just the hugest player right now in pet products. So I get my dog food at Chewy, pet medications you can get from Chewy. And so the nice thing about Chewy is that they are still growing revenues as well. So I think that, typically in a recession, discretionary stocks get hit, right? Because people don't have as much discretionary income. And technically, Chewy is a discretionary stock. But I believe that in a recession, people aren't going to stop feeding their pets. That would be horrible. And they're not going to stop buying important medications for their pets. And those are Chewy's biggest moneymakers. So we can see that in the past 5 years, well, Chewy has not been trading quite that long. They started trading in 2019, but they're also down. So there's a common theme with the three stocks today, is that they just have been beaten down, and their fundamentals are still solid. So we can see, let me scroll down to their revenue here. You can see that the revenues have been growing very, very steadily. There's nothing wrong with that at all. They are squeaking out a little profit here and there. This past quarter they didn't, but just as a general rule, they are. I think what is causing investors to be shy of Chewy is that they have a high PE ratio. If you look at that, that's absurd, 900 PE ratio. That's because Chewy is not a value stock. Chewy is a blend stock like PayPal. They're investing heavily in growth right now. So they're spending a lot on marketing, and then they're trying to move into new areas. So they're expanding into Canada. So hopefully their thought is they're going to continue to grow. So I don't think that this type of growth that we saw, I don't think that's sustainable. They're not going to continue to grow that quickly at double-digit percentages. But I do think it makes sense to expand into other countries and capture new customers. And then once that's happened, they can cut down their marketing spend, rely on their very, very loyal customers, and they have a huge percentage of recurring revenues. So those are very safe revenues. It's going to be hard for someone to go in and stop buying dog food from Chewy because it just shows up every month. Chewy's got that advantage that most of the revenues are recurring, which is so nice. We gotta love that with a company that sells a low margin product. So let's head over to Morningstar. Chewy's a 4-star stock. Used to be 5, but it has kind of had some recovery lately. And I think they actually lowered their estimate based on Chewy's last earnings report, which was, nothing to write home about. It was pretty much business as usual. They expected a little bit slowdown. But I still think there's a lot of potential here in Chewy. So let me go to my spreadsheet. If you're new to the channel, you may not have seen this is my disruptive investing themes. But even if you're not new, you haven't seen this, this is my dividend stock spreadsheet. So I created that so that I could look at Pfizer and some other dividend stocks that I'm researching right now. So let's start with Pfizer. So Pfizer is actually the highest scoring stock on my dividend stocks model. And so I only rate dividend stocks on 3 things. It's just yield, valuation, and size. So I give, more of a higher score to larger companies because I find that they're more stable and can continuously pay a dividend more reliably. A higher yield to an extent is nice. I kind of punish companies that have a double-digit yield because that's not sustainable in my opinion. And then also valuation, I look at PE for dividend stocks, so a lower PE will give you a higher score. So right now, Pfizer is the trifecta. They have a nice low PE. They're a good market cap above $1 million. And they have a decent yield of 6%. So, and I put this in manually. This is going to change every single day, so I'll just go in and update this as I need to. But anyway, so all this is to say that I think Pfizer is a nice buying point right now. I'm not going to tell you to buy it, but I think it might be a good one to add to your list and do some research on. So there's Pfizer on my dividend stock spreadsheet, and let me know in the comments if you want to see more dividend stocks or if you prefer the growth stocks. I'd be happy to hear your feedback. Here's my disruptive investing. This is where I rate on 4 metrics. So we have growth, valuation, margins, and revenues. So the higher your revenue number is, the higher score you get. The higher your margins are, the higher score you get. The lower your price to annualized sales means they're cheaper, the higher score you get. And the higher your growth, the better score you get. The maximum score is 20, which I've never had happen. I think it's impossible. Right now, Expedia and OpenText are leading the way. This is my opinion of what I look for in stocks. Maybe you look at something like Expedia or OpenText and say, oh, I'm not interested in a company that's only growing 10%. And, it's kind of one of those where it's like, well, these aren't necessarily hyper growth stocks, but they're also not really value stocks. So maybe that's not your style. To me, I kind of like stuff like that. I like a nice low price to sales with growth and high margins. I feel like that's kind of just the sweet spot for investing. So anyway, all that is to say is that this is my criteria, not necessarily what I think everyone should look at. So anyway, you can see that PayPal is high up on the list. So my average score is 11 and PayPal is a 13. So they score above average on my list, helped by their decent gross margins, but just huge annual revenues and very low price to annualized sales while still growing revenues. We like to see positive year-over-year growth. It's only single digits, but with the price to sales of 2.3, price to annualized sales of 2.3, you really aren't paying very much for PayPal. So like I said, I think the market is pessimistic. So PayPal gets a nice high score. And then Chewy is also on my list, but Chewy is a bit deceptive. So Chewy ranks an 11, which is average for my sheet. What's hurting them? Well, their margins. And like I said, this is not an exact science, but I really like companies with high gross margins. And that's why I cover a lot of software stocks, because they have really nice gross margins. So I kind of have to shift my focus a little bit and say, well, Chewy sells dog and cat and pet products. Those things are not going to have huge margins. They're more of a Walmart approach, where they're going to do a lot of volume with low margins as opposed to not as much volume with high margins, right? So we can see that Chewy's price to annualized sales is 1, so that's quite cheap for the spreadsheet. They are still growing, actually about the same amount of growth as PayPal, about 8%. They have huge 10 billion annualized revenue numbers, and their margins are fine, right? I mean, they'll be able to turn profitable as soon as they cut down on their advertising spend. So anyway, so those are 3 stocks that I think are a reasonable value today. If you're looking for stocks to buy, I would recommend adding them to your watch list. I'm not going to recommend that you buy them, of course. I'm not, no one should tell you what stocks to buy. They should simply, give you some guidance and set you free to research them yourself. So anyway, I hope this video was helpful. Please leave me a comment if you'd like to see something else, or if you have any feedback, or even if there's just a stock that you want me to cover. I don't have a huge queue lined up right now of videos, so if there's a stock maybe that's on my list or that's not on my list, let me know. And if you want to see my list, let me know. I put it in the description of my first video, so you can find it there, but I need to update it. So anyway, thanks for watching, and I hope you have a great day.